2022 has been a difficult and a challenging year for investors. Both the equity markets and the bond markets have declined a lot. And I'll get into that and show you what those look like. These charts show some interesting patterns. I think you'll find these interesting that are, frankly, I think they're a little bit confusing or uncertain. So I'm Ben Reppond. Welcome to my YouTube broadcast. Today is December 28th, 2022. We'll begin with a dashboard. This shows four major indexes for equities in the U.S., two foreign indexes, and long-term government bond index. So the things that then I rank them from the best performer or the least worst performer. If you look at the numbers in the center of the page, the far right column gives you the percentage loss of each of those indexes, going from the Dow, mostly value stocks, down about 8%, all the way down to the bottom of the NASDAQ 100, QQQ, down 33%, and the long-term government bond down 32%. A couple of things to note here. One is and you'll see this in the charts, the foreign indexes, EFA, which is developed countries, and EEM, emerging markets, are stronger, quite a bit stronger than the U.S. market. And we could get into theories on that, but as you look, that would be the second line. You see green dots, meaning that that index, developed countries, is above its 20, 50, 100, and 200-day moving averages, all of them. And emerging markets is above the 20, 50, and 100. So those definitely show strength. And of course, as I said, the Dow has done very well this year, relatively speaking, and is above 3 of its moving averages. Everything else is below its moving average, and some of them are substantially below. So the government bond, NASDAQ 100, and even the S&P 500, all below all 4 moving averages. The next chart is the sectors, the 11 sectors, starting with energy at the top, which still has a gain of 58% for the year, but everything else is negative. And at the bottom, you can see that consumer discretionary, XLY, is down 37%. XRT retail is down 33%. Telecommunication down 32%. Some really pretty deep losses. And those are all part of the S&P 500. So, some are above some of the moving averages, but none of them are above all of them. And for the 20-day, the more recent period, say the last month, only energy is above its 20-day moving average. Okay, so let's take a look at the S&P 500. This is a one-year chart showing, it's a weekly chart showing one move equals 1 week, up or down, and you can see the general direction, the macro direction is down. And the short term for the last couple of weeks is also down. So it's now, as you saw from the previous data, still below its 20-day moving average, and this is the 20-period moving average, which is using weekly data. When I compare, this is interesting. You can see for the entire year, almost all of the time, not quite, but almost all of the time, that when we put growth as the numerator and value, excuse me, as the denominator, if it goes down, that means that value is in favor. The denominator is in favor. If it goes up, that means growth. Stocks are in favor. So you can see where it's going, and even at the very end of the chart, it's not only going down, it's accelerating going down. So growth is out of favor. It's value, or even Dow stocks, blue chip stocks are more in favor. This next slide is compares, it's a ratio chart also, it compares the Russell 2000 small cap exchange traded fund, IWM, to the S&P 500 ETF SPY. So IWM is the numerator, SPY is the denominator. What that means is if it rises in value, that favors small cap. If it declines in value, that favors large cap. So you can see, this is a 24-month chart, so you could see for about 21 months that it favored large cap over small cap. So small cap has been way out of favor. And but as you see at the very beginning of the chart, there are times where small cap comes back into favor, and that will happen at some point, but it's not yet. The long-term government bond, TLT, ETF, TLT, this is a 30-month chart, and I use 30 months so I can show you both periods of decline. You can see where it's gone down a lot and then tried to go back up and then down again. At the very end of the chart, it still tried to go up and has collapsed from that. So it is not in yet a growth mode, which means interest rates are going up. They foresee them going up, which is why they will sell this, and therefore bonds, and in this particular case, TLT, be selling that. Now, this is the long-term government bond, and the short-term bond, or excuse me, the intermediate-term bond is a 7 to 10-year bond, very similar chart, and the short-term bond, maybe 2 to 5-year bond or 1 to 3-year bond. Short-term bonds, same thing. They're going down, and they just go down at a different rate. When I calculated this for this year, TLT has dropped about 37% this year. Now, the reason that's significant is that is a big part, or something similar to it, is a big part of buy and hold 60-40 portfolios. So portfolios have been decimated. Buy and hold portfolios, not only have equities declined, we saw where NASDAQ 100 down 33%, maybe the S&P is down 20% or so, the Dow's down 8%, but depends on where people were invested. But I would say probably what's average is equity. Most people's equity portfolios are down about 20%, and depends where they're invested in bonds. I think it'd be very easy to say somewhere between 20 and 33%. The reason that a lot of people use TLT, or the long-term government bond, is that for a long time, that was the best performing bond and was the most counter-directional to equities. So those that wanted to balance a 60-40 portfolio were using this or something very close to it, because it was the best counterbalance to equities. So I'm not just picking on the worst index this year, I'm picking on the one that for a long, long time has been the best index, but it has fallen apart. And so it's causing, traditional portfolios a lot of trouble. The dollar. The US dollar, up until, about 5 or 6 weeks ago, we're thinking, where is this going? Why is the dollar going up so much? Well, it corrected. So now you can see the dollar has started to come back down, has broken below its 20-period moving average. And I don't know the direction long term, but I'd say it seems to be pointed in a downward direction. Gold has rallied. It's come back. And it hit a low, and you can see I put the arrow at the bottom, and is moving back up. It's up above its 20-period moving average and seems to be on an upward trajectory. Silver, even more so. Now, when gold and silver go down, silver usually goes down a lot faster and further than gold does. But when they go up, as you can see here in the last couple of months, silver goes up faster. So silver is more volatile on the upside and the downside than gold, and is certainly moving up quickly. When I compare the two, putting silver as a numerator, gold, GLD ETF, as a denominator, it looks like this, very similar. So the silver is definitely outperforming gold. The Next is Bitcoin. I put this in here. One of our viewers wanted me to show it, which I think is a good thing to do, to show you this. It's gone from, this is GBTC, which is the exchange traded fund that's used as a surrogate for Bitcoin. And it's fallen, I don't know the number, I think it's about 75% from its high. It's fallen a lot. I know that Bitcoin itself has fallen from around 65,000 down to around 16,000. So then there are people who are saying it's going to go down to 10,000 or below. I don't know about that. That's speculation. But you can certainly see it's in a strong downward decline and does not show any strength of recovery at this point. The volatility index, the VIX, is an indicator of market volatility. And you can see that this was actually as of last Friday, so it may have gone up a little bit since then. So I put the marker at 24, showing that if it's below that, generally speaking, it's a positive thing, so volatility is decreasing. If it goes above that, it shows volatility is increasing. So you can see periods of time in the last year where we've had plenty of both. Asbury Research does 6 indicators, and they measure different aspects of the market, and all 6 of those are negative, and I think they were all negative last week. They also do a cross-asset relative performance showing what is in favor using ETFs for each of these and which ones have the strongest relative performance to each other. Now, when I say strongest, what I mean is if they are both declining, which one is declining less? And if they're going up, which one is going up the most, etc. So this measures, on the 3 right columns, measures weekly, the last week, the last month, and the last quarter. So these are all relatively short-term periods, but you can see, as we've talked about earlier, low volatility, blue chip stocks, value stocks, typically low volatility, those are in favor over higher volatility or high beta stocks. Blue chip stocks, same thing, more in favor over the broad market, meaning the S&P. The broad market, the S&P, compared to the NASDAQ, from the previous charts, the broad market is doing better than the NASDAQ or the more technology growth-oriented companies. Growth or value stocks, same thing, growth, value over growth. Developed countries over U.S., you saw that one too. Developed countries are doing stronger. And 2 green boxes for the emerging markets. They're not as strong as developed, but they've shown strength over the U.S. market. When you compare the U.S. versus the world, you can see that there's not a single one of these where the U.S. is strong enough to get a green box over other countries in the world. Some of these are developing countries and some are developed countries, some of both. But you can see for yourself the ones that are all 3 green boxes going across, all stronger than the U.S. I take the developed countries, which we just saw, that are outperforming the U.S., and the ETF, EFA, is a surrogate for developed countries. And I did a ratio, the U.S. SPY divided by EFA, to find out which one relative to the other is doing better. So it's a relative strength chart. You can see, and it goes up and down a lot. And there are times where the U.S. has done very well relative to developed countries. But at the end of the chart, you can see what I've been talking about, that developed countries, in this case EFA, are doing much better than the U.S. to the extent of that black line. So if we were to invert that and make EFA the numerator, it would be going up that much, favoring developed countries. So that will change at some point, but it is a short-term trend. And then this is as of the 27th. This would be Tuesday. The gold price was $18.15 per ounce, and silver was $24.11. As you saw from the previous chart, the gold was up almost 1%, and silver was up over 3% from the previous Friday, about a 10-day period of time. I hope you have a happy new year. I hope that 2023 brings you good health, brings you prosperity, and I'm assuming that most portfolios are down. I hope your portfolio recovers, whatever your method of investing. But as I reflected on 2022, contrasting what our hope is for 2023 with our reality of 2022, I thought of the things this year that have put such a headwind on both investments, but other aspects for us individually and for our economy. I wrote them down, and this just what came to mind. So I didn't do any research on this. I thought of this. We started the year with the Ukraine war. That's gone on all year. Stock and bond market declines. That's happened. Well, we've seen stock market declines, but do you ever remember, or have you ever heard of a bond market that's gone down as much or more than the equity markets? That's unusual. Bitcoin collapsed. FTX collapsed. Sam Bankman-Fried was arrested. Now we have the worst winter. I've heard this said, and I don't know if this is just New York, but I heard it, or upper New York. I heard it said, this is the worst winter on record. I don't think it's the worst where I live, but if they said that in Buffalo, I think that's pictures I've seen are not good. But I think maybe 2/3 of the U.S. population has been affected or seriously affected by this winter, and it's not over. We've had high inflation, rising interest rates, and slow growth projections or even contraction ahead of us. So I looked around trying to think, where's the good news here? And as you can see from the market, there isn't much good news right now. Now, I will say this. While I'm wishing you a happy new year, I will say things change. So this market, while I think there's probably some challenges ahead of us for some of 2023, I am hoping that for part of 2023, we will have the opportunity to see some recovery in the equity market, and I can't speak for the bond market. I'm not an expert on that, but I am hopeful that at least the equity market will improve in 2023. Anyway, have a happy new year. If you have questions or comments, leave them in the comment section below, and I will try to answer them. Thank you.